Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include what we're seeing with returns on agency mortgage-backed securities versus other instruments, my interview with ICE's John Hedlund on his career in the industry, and we have the latest on President Trump, Director Pulte, and Fed Governor Cook. Do you know that Figure is shaking up the lending world with their 5-day HELOC, offering borrower approvals in as little as 5 minutes and funding in 5 days? Figure has hundreds of partners in the banking, credit union, home improvement, and, of course, IMB space embedding their technology. Lenders give your borrowers an experience they'll rave about. You can learn more at figure.com. As my dad puts his faith in commercial air travel today and heads off to the Mortgage Bankers Association of St. Louis event, which happens to be tomorrow, and Thursday's Mortgage Bankers Association of Kansas City annual luncheon. Which, speaking of Missouri, the Pony Express ran between St. Joseph there and Sacramento for 18 months in 1860 and 1861, though it was put out of business by the Telegraph. I actually had an ancestor, Frank Duffy Derrick, who rode the Pony Express. Anyways, the Telegraph was a great example of better, faster, cheaper winning out. Non-agency investors, such as non-QM, DSCR, HELOC, and second investors, have certainly gained market share at the expense of the agencies, namely Freddie and Fannie, perhaps for the same reason. The FHFA, Fannie, and Freddie have been distracted with Director Pulte sending out information on mortgage portability, 50-year mortgage amortization, tech companies doing business deals with the GSEs with possibly an ownership stake in their companies, assumability, and more. Well, Fannie Mae allegedly shared pricing information with Freddie Mac. All that's kind of obfuscated the feud with Fed Governor Cook over mortgage fraud. Recall the situation. President Trump wants to fire Federal Reserve Governor Lisa Cook from the Fed over alleged fraud involving her mortgage applications. Fraud involves proving intent, and Cook has denied wrongdoing and is challenging her removal in court, so far with success. The Supreme Court has for now blocked Trump's attempt to remove her, and we'll hear arguments on January 21st. Trump's effort to remove Cook from the Fed board is unprecedented. Since the Fed's founding in 1913, no member of the Fed's 7-person board of governors had ever been targeted for removal by a president. Cook was sworn in last year to a new term at the Fed that runs until 2038. Her lawyer on Monday provided the first detailed defense of her mortgage applications, arguing that apparent discrepancies in loan documents were either accurate at the time or an inadvertent notation that couldn't constitute fraud given other disclosures to her lenders. The letter addresses mortgage applications for 3 properties Cook owns: a home in Ann Arbor, Michigan, a condominium in Atlanta, and a home in Cambridge, Massachusetts. Trump administration officials have focused on the Ann Arbor and Atlanta properties, which Cook bought or refinanced weeks apart in 2021. Standardized loan forms that Cook signed show she pledged to live in each home for a year as her principal residence, unless the lender otherwise agreed to a different arrangement. Pulte suggested Cook could have received favorable lending terms, such as lower interest rates, by misrepresenting her occupancy status. The Justice Department has opened a separate fraud investigation, but hasn't filed charges. The Ann Arbor home was accurately described as Cook's primary residence when she refinanced it in 2021, her attorney said, because she was still living there and employed by Michigan State University at the time. Former President Joe Biden nominated her to a seat on the Fed's board in 2022, and she began renting out the home with the proper local licenses to do so after moving to Washington, D.C. for the Fed job. She bought the Atlanta condo to have a permanent place to stay when she would visit relatives after her family sold a jointly owned home in Milledgeville, Georgia, that same year. Although one line on the mortgage application for the Atlanta condo listed the property as a primary residence, other records show this was at most an inadvertent notation, her lawyer said. A separate May 2021 loan estimate provided by her lender shows Cook had identified the property as a vacation home. Her lawyer suggested that Bill Pulte's use of the criminal referral process would weaken the referrals he made against Cook, saying that using the arms of FHFA and the companies it controls to selectively and publicly investigate Trump's political enemies gives rise to the unmistakable impression that he has been improperly coordinating with the White House to manufacture flimsy predicates to launch these probes. The Federal Reserve Act doesn't permit removal of a governor because of disagreements on monetary policy. The president can only remove governors for cause. The law doesn't define cause, though it's often understood to be related to inefficiency, a neglected duty, or misconduct in office. The case has obviously attracted attention from economists and investors because a ruling in favor of Trump would make it easier for the president to dismiss Fed officials and neuter a guardrail that has allowed the central bank to argue it enjoys greater autonomy or independence over interest rate decisions. Investors could worry that the Fed won't be able to take sometimes unpopular steps to control inflation if its independence was severely weakened. For today's interview, I wanted to welcome to the show ICE's John Hedlund to talk about his life in mortgage, how mortgage leaders can scale sustainably, unlock new innovation and risk in operations, balance efficiency with human-centered borrower experience, and prepare for the next major shift in housing and the lending cycle. Rather than going through his whole background, I'd kind of just want to ask him about his career from the jump.
I'm very pleased to have you on. You're the ICE Vice Chairman, your recent MBA Vice Chair. Before we get to ICE and MBA, I want to back up a little bit to your time at AmeriHome. You were responsible for all of operations. You also ran the production business for the company. There was a lot of time in sales, marketing, business development. Your fingerprints were on everything. Under that stewardship or leadership, AmeriHome became the second largest correspondent lender in the U.S. Key decisions, cultural shifts you led that paved the way for that scale, kind of, what you're proud of about your tenure and anything hindsight 2020, considering the current market we're in?
First off, Robbie, always a pleasure. Thank you for the invitation. Enjoy hanging out with you as always. A few lessons and things that we did that I think helped with our success. Some of them were thought out and planned, and some of them were probably fortuitous and somewhat lucky. First up, the group of founders, myself and my other colleagues, I think we're very fortunate. We all came from countrywide B of A, so it worked en masse at a large-scale correspondent lender. And each of us were, well-regarded and quasi-experts in our own area of focus. So I think that helped us. We had a really solid group there. Secondly, kind of building on that point, we all had large teams at, I guess, last Bank of America. And with what the bank was doing at that time, they'd recently, one of the reasons we started AmeriHome is because Brian Moynihan and Bank of America exited the correspondent business and left a huge void. And we saw an opportunity. So that's how the small group of us got together to found the company. And then secondly, we had an ability to be very thoughtful and strategic in picking our team from past colleagues. So really the best of the best we were able to bring over. They already knew the team that we were working with. They knew the leaders they were working with. They knew the culture, the work effort, the vibe. So that was very seamless and worked out excellent. The other thing we did that I think was, again, in hindsight, very thoughtful was the four of us agreed that at least for the first 100 people, somewhat senior, not necessarily everybody, but we would all interview. If I wanted to bring somebody on, the other three guys would interview them, and everybody had, a free thumbs down. If they felt it wasn't a fit, didn't think they fit what we were trying to build, the culture, whatever the case may be, they could pass, and we just moved on from there. We didn't have many that we said thumbs down to, so to speak, but the vision or the intent of that was really, as you're building any sort of a team, whether it's sports, social group, community group, or work, is the thinking was, if we can get a solid group to start and throw the number 100, 150, 200, that really does embrace how we felt the company culture should be, then future hires are more likely to embrace an existing culture than to be disruptive, right? Team dynamics kick in. So we did that, and I think that turned out to be very successful in establishing that culture where we looked at, really trying to hire for three main things. We wanted people that were smarter than average, think on their own, make good decisions within their realm of authority. We wanted people that were passionate when they were at work. They cared about the customer, they cared about their colleagues, they cared about the quality of their work. And then lastly, it's a very, particularly in a startup, we were all working very, very closely, just a group of desks side by side every day, long hours. So people that could work and operate effectively in team dynamic. And that does not mean conforming to your boss or being consensus oriented. It means, supporting your point of view, listening to other points of view, challenging where required, and, continuous mindset in terms of trying to always improve the process. That's what we're looking for. So those three main things made it easy. And that's really the lens that we looked at all future hires. The other big one is a correspondent lender. As you know, we acquired MSRs, and MSRs, you basically pay today for future revenue streams. So it is a capital intensive business. It probably took us a year and a half, 2 years, year and a half to find an investor with the capital and the vision to kind of support us. And we were very fortunate, again, through relationships, which is mostly how this world works. Previous contacts that we hooked up with Apollo Global Management and Athene Insurance. And they committed to the business, the capital that was required. And in addition to that, were just great business partners, smart people, very knowledgeable, and really helped us grow the business. So that was also a great factor in our success. Certainly, there were lots of headwinds when you think about the time that we started the company, 2013, still dealing with the effects of the Great Recession. But we also had some significant tailwinds, if you will. As I mentioned previously, Brian Moynihan and Bank of America pulled out of the correspondent space, really the space previously filled by Countrywide, the number one buyer in that space. And really over the next 7 to 10 years, you saw continuous pullback, some slightly, some more dramatic, particularly Wells and Chase in the correspondent space that really opened the market up to IMB, which we were at the time. And that was great. It did a couple things. One, the banks, which is maybe one of the reasons they pulled out, at times could have, at least in our perspective, irrational pricing. That was certainly, as I think about it, a great tailwind for us and really the whole IMB industry during that time. The last part I would just say was just, again, given level of people we brought in, not only the founders, but other senior management, executive team members, had broad relationships across the industry. My sales team, I hired experienced salespeople that had been in the space for many, many years, had lots of contacts, were well regarded, well respected. And all of that really added up to making it a success. It was, a huge team effort. And I talked a little bit about our value prop, and one of the key ones is competitive pricing. And by that, I mean, we're there every day for our customers, always delivering a competitive price. And the second one was leading the industry in service. So speed matters. People want their money. They want their loans cleared off their lines. And we monitored, managed that, invested heavily to improve our technology, our processes, to make us a leader in that space. You need to do a lot of volume to reduce your cost base, right? To lower your fixed costs, spread it over more loans. And we were very successful with that. That helped us with our main value prop, which is being competitively priced in all markets. Because if my costs are low, I can do more loans and still make a little bit.
So the last I heard from you at AmeriHome, it was, I'm riding off into the sunset. Then all of a sudden I'm going to be vice chairman at ICE. Thoughts behind what encouraged you to take that role? I don't know if it was something that you foresaw when you left AmeriHome.
No, it was not what I envisioned at all when I left AmeriHome. When I left AmeriHome, I wasn't sure I didn't want to work full time again. I knew I wanted to take a little time off, but I just felt that we'd sold AmeriHome to Western Alliance Bank, great partner, great company. And it was no longer my company. And I had a lot of great people on my team that could certainly do more, potentially better than I could. And I just felt I'd stayed my welcome, and it was a great run, great memories, great team, a lot of friends there. But if I was going to do something, I was going to do something different. But initially, it was basically retiring, which turned out after about 8, 9 months to get a little boring. And so I'd had a fairly long-standing relationship with Ben Jackson, who runs ICE, Tim Bowler, and many others on the team. I was an Ellie Mae and Black Knight client. Black Knight was our first system we used when we started Amerihome. So I had a history with some of those folks. I did a little consulting for ICE. And in just talking to Ben, this role came about. And I couldn't be happier. Again, I had a good feel, consulting for them, for the people, their culture. I see it as very entrepreneurial. They're very passionate about what they do. They want to be the best. They want to continue to innovate their products, and they really care about what they provide to their clients. So all of that resonated very well with me. And while I'd never been on the technology side, that appealed to me. A little intellectual stimulation, having to go back and be the rookie, learn some new things, and all of that interests me greatly. But it was all done within something I've done for almost 40 years in the banking and mortgage industry, and the relationships I've built and the connections and understanding the ecosystem fairly well. So it's been a great first 6 months, and I'm looking forward to continuing the journey with them as long as that goes.
Yeah, can you explain the role a little bit for people that might be unaware? What's your day-to-day look like? What's the longer-term strategy and what you're building towards?
Yeah, I kind of summarize it as, I'm there to help the rest of the executive team and the rest of the ICE team really continue to improve and drive the business, drive it for our customers, drive it for our employees, and drive it obviously for our shareholders. So whether that is M&A opportunities, whether that is other aspects of the business that we have areas and opportunities to improve on, working with our customers in our customer needs. I spend a lot of time with our clients and with our sales team, working with whether it's relationships from the past or new relationships.
So you also are vice chairman at MBA, recently announced. Congratulations on that. And
Yeah.
I want to talk about that role a little bit too, because it is a revolutionary time for the mortgage industry, if you will. And I guess I will, in saying that with the rapid evolution of tech, expansion of the way it's working to make the process more efficient on all sides. You're serving as MBA vice chairman for 2026. You've done extensive work with MISMO and other industry standards groups. I wonder how you see kind of the role of these organizations, you can speak to MBA specifically, evolving in a market that's increasingly driven by technology, regulation, data, so on and so forth.
Yeah, great question. And yes, I'm long on vice chairman titles right at the moment. But several years ago, I was looking to get more involved and talk to my good friend, Mike Fratantoni, who I know you know well as well. And Mike kind of launched me on this journey probably, 10, 11 years ago, 12 years ago, maybe now, where I joined RESBOG, which is the Residential Board of Governors for the MBA. And they really are the policy arm on the residential side. There's also one called COMBOG for the commercial side. So I spent 6 or 7 years there, ultimately became chair of that as well. And really there you are deeply involved in the policy side, advocating on behalf of our industry. I also had the opportunity to get involved with the California MBA. I was chair there in 22 and 23. I'm still on the California MBA board. And years ago, I was involved briefly when I lived in Texas on the Texas MBA. As well as you said, I was chair of MISMO for a couple of years as well. So I've spent a fair amount of time in the trade organization space. I'm a big, obviously firm believer in the value they bring to every industry, but particularly the mortgage real estate industry that we're in. And I think about it, having been involved for 10, 12 years now at some level, there are so many bills when you take all the states and federally And without having people like we're fortunate enough to have at the NBA and all the connectivity that they have, and really all the state organizations, monitoring and working with the legislators to help them understand our industry better. Most of the bills are not being written by mortgage experts. And really the biggest concern that I think we have is not so much the intended consequences and the obvious bills. It's going through some of the more innocuous bills looking for implications to our industry. And we've had numerous of those that without the strong advocacy that we have and relationships, bad bills would get passed into law that we are then bound by for whatever period that may be. And that requires a strong membership. It requires money, and it requires, a lot of work on behalf of, again, all the national MBA and all the other state legislatures or state MBAs. So, I feel very fortunate to be back on the board in a leadership position. And when you talk about, technology, regulation, data, technology, maybe hold that out to the side a little bit, but regulation and data is, those are all potentially bills or regs that end up potentially impacting our business positively or negatively. You're seeing potentially under this administration, maybe somewhat of a relaxation in some form or fashion at the federal level, whether that's the CFPB or other organizations. But, being on the California MBA, I can see what's happening at the state level. And then you multiply that by 50, that's probably a worse scenario and much harder for a lender who's national in scope to administer 50 different sets of rules and nuances than it is a federal bill. So they're all important. The great news is the MBA works very tightly with all the state organizations. So it's pretty coordinated, but there's never a dull moment.
Yeah, the industry certainly needs people like you that know where it's been and can help usher it in responsible and really intelligent ways to where it needs to go. And in that vein, I would say it used to be that Fannie and Freddie were the ones driving innovation, and they've almost taken a back seat here. And you hit on some of the themes, in terms of regulation or whatever might be coming out of DC right now. Fannie and Freddie have started to take a little more of a back seat. And so it's allowed for this vacuum or white space when it comes to innovation. And I'm talking specifically in operations and risk and compliance, those sorts of things. Where do you see the biggest potential or opportunity for innovation over the next couple of years here for the industry?
I think all of them have big opportunities for technological enhancements, whether that's just further digitization, automation, or true AI, or some combination of the above. I think what we've seen over the last 5 years, but maybe a little longer, that data and information is becoming increasingly important and really becoming a fungible product commercially. There is huge value in analyzing and dissecting data, whether it's, thinking about the mortgage industry, all the climate and disaster related stuff. One of the things AI is going to do is allow us to digest massive amounts of information much quicker, more efficiently, and in a more precise way than we've ever been able to do before in a cost-effective manner. To answer your question, I think about it, I could see every one of these areas being impacted substantially over time. Will it be as fast as we think? I doubt that. Nothing ever has happened as fast as we thought. But I think there will be a lot there that impacts both, when you talk about the risk side, I mentioned one thing there just in terms of the information processing power and learning more about climate change, et cetera. But, loan quality, understanding that better analysis up front. We'll see if automated underwriting tools lead to better decisions, perhaps. Are they less biased? Perhaps. Do they focus on what's critical versus what's uncritical versus a human being? Perhaps. That will evolve. But I think every area, compliance is a huge one. And certainly, the one we're always trying to attract is really just the cost of doing loans in our business. I think erroneously the 10, 11, $12,000 a loan is thrown out there, but 60 to 65% of that is really sales commission associated costs. So really the cost of a loan is considerably less, call it $3,500. But that's still a considerable number. At the same time, we start to make headway in that. Loans change, programs change, non-QM loans, jumbo loans, all of them much more difficult to underwrite. New documentation's coming into it, other sources of income. So I know people get frustrated that we don't appear to make a ton of traction in reducing the cost per loan, but I think we have to remember it's always changing. Regs are changing, rules are changing, docs are changing, programs are changing, borrowers are changing. To answer your question quickly, I'm not sure I would rank those. I think you will see advancements in all areas and improvements leading to better data, better information, better facts on which people can make better decisions.
Well, you've led me directly to the $1 million or $1 billion or $2.2 trillion question. And that is on the relationship between technology and humans. And I don't want to say technology versus humans because they should work in conjunction, in tandem with a symbiotic relationship with one another. Obviously, lenders are grappling with a lot right now. Could be those cost pressures you mentioned. It could be regulatory uncertainty that I mentioned. In general, kind of delivering this high quality borrower experience. I guess the meat of it is, how do they balance operational efficiency, that's automation, and scale with building these genuine human-centered relationships and kind of trust in their origination and servicing models?
I think that's interesting. I think the majority of people I speak with and I'll read public companies' financials and earnings statements. I think the vast majority still see humans being central and critical to the process. There's a handful of outliers that talk about full automation and or attacking, at least substantially, the role of the LO. At ICE, we do see humans as being central to the process, whatever the short midterm is. But we are building our automation, our technology, our digitization, our AI tools to make life easier, more cost effective, improve the quality, reduce the risk, whatever your role may be. So as an underwriter, we don't envision in the foreseeable future an underwriter, a physical human being, not being involved to some form or fashion in that process. Now, we continue to chip away at that with our tools and solutions that ensure underwriters are being used for what underwriters want to do, which is make quality decisions based on the information available. So we're trying to take a lot of that information collecting, the actual analysis, and automate and digitize that, allowing them to look at the facts, look at the case, compare it to the program guidelines, and see if this loan fits the box. Same thing if we take the loan officer. We still see the loan officer, particularly in the purchase world, as being a critical component. You take first-time home buyers. I don't know, I bought 9, 10, 15 homes. I still find it a frustrating process, and I'm in the business. So your first few times, it's quite a process to go through. And having a trusted advisor that's supporting you and is on side and aligned with your objectives, which is to close the loan or they don't get paid. So you are very aligned. Having that person key and central is critical to the process, in our opinion. Having said that, having the loan officer with up-to-date information, i.e. status and underwriting, being able to look at review notes quickly to get back to a customer and find out what the situation is, not having to play phone tag or email tag with their processor or underwriter, and or communicating with the borrower and how the borrower wants to be communicated with, whether that's the phone, email, online, on their phone, whatever. That's what we're trying to do. So really the focus on that end is increasing the productivity of the loan officer by removing non-value add tasks from their days. In addition, as we kind of move into this next phase of the market, considerable time and energy on the recapture aspect of it. Whether you own MSRs or you were the original originator, that is a great opportunity, as we all know, for lenders and servicers. And it's gotten increasingly competitive out there. We have a few major players that are very open about their strategies and where they plan to be next refi boom/boomlet. So that's an area of great focus for us at ICE in helping to equip all of our lenders with all the tools they need to do that in the most efficient, effective manner with their borrowers to look after their needs.
I told you before the interview I was going to ask about industry priorities over the next couple of years, but you just outlined them. So I'm gonna switch here slightly. My dad, when I ask him, what the purpose is of what we're doing, at least at Chrisman, and he says, I want to add value to the industry. I want to add value. I want to add value. You've served on the board of the California MBA. You're in Resbog, as you mentioned, ICE, AmeriHome. You've been integral at companies that are very important to the overall mortgage ecosystem. What would you like your 10-year time in the mortgage industry to be remembered for at some point long from now?
Wow. Okay, that is a change. When I left AmeriHome, and it was tough because I spent a lot of time. We had some tough days in the early days, even some over the later days, because that's life in the mortgage business. And it was tough in the sense that I will not be working day to day with people that I've grown to really respect and admire and become close friends. And so one of the things, to your opening question, why did I go back to ICE, is at my core, I was not ready to retire and kind of walk away. And I missed the relationships. I missed the competitiveness of the industry. Consulting was fun and you try to add value to your clients, but ultimately you're not there to see if your recommendations helped or hurt. And I'm a competitive guy and I like winning. Unfortunately, to win, you have to sometimes lose. So just that competitive makeup, I think that's important to who I was. And I enjoyed and will look back to all of the roles I've had over my currently 38 years and every company that I was part of, being in the trenches and working with those folks on shared common goals. I loved and will remember fondly, my role as a leader and helping to develop people and hopefully help their career goals and help them grow and prosper and become what they wanted to be on the business side. And really all the relationships. From my time, with the MBAs and the other trade groups and organizations, they've been around a long time. They'll be around a long time after I'm long gone. But just, for an industry that gave so much to me and my family, I really do just want to give back. And that was always my purpose, whether it was Resbog, the MBA, the California MBA, MISMO, or back at the MBA, is, spending some of my day time giving back to the industry that has been very good to me and my family and a lot of my colleagues and friends.
John, this was a real pleasure, man. This, a lot of interviews, people come on and they want to talk the latest and greatest in product innovation or whatever. But I think that this kind of a mortgage life type interview, if you will, is something really neat. So I'm very appreciative. It's always been a pleasure spending time with you, and I consider you somebody to really look up to in the industry. So thank you very much.
Oh, thank you, Robbie. That's very kind. And I feel the same. Always enjoy spending time with you. And of course, your dad as well. So give him my best.
Will do.
Federal economic data is resuming after the shutdown, and we learned yesterday that construction spending rose 0.2% in August, its third monthly gain, driven mainly by higher residential renovation and multifamily building. Overall activity remained 1.6% below last year, and any growth came from housing-related projects, not from new single-family construction. The September payrolls report, now set for Thursday, will offer the markets its first major data point since the government shutdown and will help shape expectations for the Fed's December 10th meeting, despite being somewhat stale. With policymakers emphasizing that another rate cut is not assured, even imperfect data should bring welcome clarity. Though investors will treat official releases with added caution as the shutdown's distortions linger. Other Census Bureau reports this week may provide context, but are unlikely to shift the broader economic narrative. The Treasury market, and along with it securities backed by mortgages, remains range-bound, with the 10-year anchored near 4.10% and the yield curve steady at a 50 basis point 2-10 spread. Many investors expect a curve steepening into year-end, driven by the likelihood of a more dovish Fed in 2026, though this has become somewhat of a crowded view. Futures markets have nudged up their expected SOFR floor, reflecting fluid policy expectations. As a result, the December Federal Open Market Committee meeting and its updated projections will be pivotal in assessing how the Fed interprets the shutdown's fallout and the path of normalization ahead. Market volatility has spiked to its highest level in a month, though it is still near multi-year lows. Securities and their prices are often compared to similar instruments. The U.S. mortgage-backed security index slipped 10 basis points in excess return last week. Or put another way, mortgage-backed securities performed slightly worse than comparable safe investments last week, earning a little less than what investors expected based on their level of risk, with nearly all the damage occurring midweek despite otherwise quiet trading and average volumes across Class A and B settlements. Against this backdrop, the Fed has reaffirmed that any future bond buying, likely not before 2026, would be intended to maintain smooth market functioning rather than to stimulate growth, signaling a cautious and technical approach to balance sheet policy. Import prices and industrial production/capacity utilization, both for October and scheduled to be released today, are expected to be delayed. That leaves Redbook same-store sales, the NAHB housing market index for November, Treasury conducting a buyback for liquidity purposes in 5 to 7-year coupons for up to $4 billion before releasing September tick data, and remarks from Fed Governor Barr, Richmond Fed President Barkin, and Dallas Fed President Logan. We began the day with agency MBS prices slightly improved from Monday's close, the 2-year yielding 3.57, and the 10-year yielding 4.10 after closing Monday at 4.13%. Let's wrap up with a joke and some housekeeping. Thanksgiving is coming up and people are feeling festive. A man walks into a bar with a slab of asphalt under his arm. He says, "Beer, please, and one for the road." Thanks again to Figure for sponsoring this week's podcasts. Figure is shaking up the lending world with their 5-day HELOC, offering borrower approvals in as little as 5 minutes and funding in 5 days. And embedding their technology is easy. Learn more at figure.com.